I'm Charlotte McLeod with investingnews.com, and here today with me is Willem Middelkoop, founder of the Commodity Discovery Fund and author of The Big Reset. Thank you so much for being here. Great to have you.
Thank you. Good to be back.
Yes, really good to be back.
It was long flying to see you.
Yes. We just said how long your flight was. I'm really glad you're here. So let's start by talking about the juniors. I think many people will probably know Commodity Discovery Fund is focused on discovery investing. So goal is to invest in exploration companies making discoveries. We're here at VRIC, lots of juniors out on the show floor, and I think a lot of people would agree that 2023 was a pretty tough year. So what factors did you see weighing on the market last year, just to do a little bit of a review?
Yeah, actually, was maybe the most frustrating year for us as well, because gold was pretty strong, actually ended up the year a few percent. But silver was down, lithium was down 80%. The only outlier was uranium. And uranium is a great example of what can happen when the physical demand actually overwhelms the paper market. And what we've seen with uranium is a jump in uranium prices 2x, 3x within a very short time frame. Same happened with palladium in 2018. And there as well, 2018, there was the physical demand which changed it all. With the ongoing debasement of currencies and the ongoing crisis, tension, wars, gold is in play. There's huge physical demand, also for silver. So I think 2024 could be a year of recovery. But 2023 was so frustrating because there was a huge wave of selling because of redemptions from funds, investment funds. We still have net inflow. We always had net inflow every year. But there are many funds here in North America have strong outflows. And then fund managers, they don't want to sell, but they need to sell.
Okay, so 2024 looking like it would be perhaps a better year for the juniors. Yeah. And I think, when we get into these tough times for the juniors, people seem to start talking about when they see the sector not very healthy. Do we need to see a cleanup? Do we need to see consolidation there? Or do investors just need to do their due diligence and find the companies that are actually winning? What are your thoughts?
Well, I think the Canadian exploration scene, the junior mining scene, had become very unhealthy after a very strong bull market in the 2000s. Everybody and their neighbor thought you should start your own exploration fund, get money from investors, and have a nice lifestyle and give yourself a lot of options. And what we're witnessing now is that many of those companies, exploration companies, there are over 1,000 listed exploration companies in Canada, can't survive. And actually that's healthy. But you still have a few hundred exploration companies working on good projects, being able to attract money. We still invest in Canadian exploration companies, but we've been very selective, and we got even more selective over the years. So we concentrate on the top 100 discoveries worldwide now, metal agnostic, and not only run by Canadian companies, also by ASX Australian listed companies or London listed companies. So being very selective has helped us to survive in this very difficult markets. And we've seen many peers here in North America closing shop. Many resource funds stopped or have used outflows.
Yeah, I was reading up a little bit on the fund, the history of the fund, and I was interested to hear about Australia. So it sounds like at first you weren't really focusing on Australia, but now it's become quite a focus. So interested to hear a little bit more about that and maybe how things look different over there.
Yeah, in the first 10 years, we really focused on North America because there were so many companies here. We needed time to learn the landscape, to study the landscape. But then we always knew that Australia was mineral rich as well. But then we learned that, yes, 400 listed exploration companies in Australia. And we learned that many good discoveries were being done in Australia. So we started to study it and found it's an even more interesting market for us because Australia is much more underexplored compared to Canada. In Canada, every rock has been turned 3 times. And Australia has a large part has a large sand cover. And with the current development in IP and geophysics, we are able to look through the sand cover, and that's the reason why so many discoveries are being made in Australia. And so we like it. We award our Discovery Award every year, and 2 out of 4 years it went to an Australian company.
Okay. I want to talk a little bit more about your strategy. So obviously focusing on discoveries, but what I think investors tend to struggle with is their exit strategy, right?
Yeah.
So for you, do you want to be out after that discovery? Do you want to see a company take it all the way through? What are your thoughts there?
It's very simple. When you focus on the top 100 of best discoveries worldwide, they will always be taken out by a major.
There you go.
So that's your exit strategy. So when investors ask us, what's your exit strategy? We will say we wait for the buyout. And we've had over 80 buyouts since our start in 2008. So it shows the model works. And we have on average 6 buyouts every year, also last year. So in good and bad times, it works. And we've been concentrating more and more into the bigger discovery, the more significant discoveries. And now our fund has grown to over 100 million. We need to focus on the larger discoveries, the more liquid ones. And by doing that, you automatically end up with the best situations, the best companies. And of course, we trade a bit around our position. So if the stock has had a huge run, we take some profit. And this strategy has been tested now for 15 years. We need to test it in a bear market. We survived the bear market. And we expect to do very well in the next bull market, which is about to start.
Okay, one more note on exploration. So we hear a lot about the role of major miners, and one thing I hear all the time is they're not doing their own exploration.
Yeah.
So do you think they're doing enough right now? No. Okay, let's hear about that.
Yeah, because we see the shortages developing in most of the metals, especially after 25. You see the uranium, copper, lithium, and there's not enough exploration being done by majors, and some of the majors are starting to come back. For example, BHP has this program, but then they give 500K to each exploration company as some stimulus to do more research. But what we would need more money coming in maybe through governments or majors, because the exploration companies simply can't attract enough money to make enough new discoveries to supply the world with enough metals for the next few decades. So if you study supply and demand, many shortages developing, especially after 25, and this will lead to much higher prices in the years to come.
Okay, interesting you mentioned maybe we need some government funding for the exploration. A lot of governments around the world, though, are also making it a little bit harder for companies to actually do it with all the regulations. So, any thoughts?
Yeah, but politicians will start to understand in the next few years that by telling their citizens that we need to buy an EV, an electric vehicle, they forget that there are not enough metals and commodities around to be able to produce enough of these cars. So something has to give, and I think they will wake up because of very high prices. Then the EVs become too expensive, and then they have to change their policies. And I think in 2, 3 to 4 years, this will be a very big story worldwide. And now only insiders know about this.
Okay. I want to take a look at some of the different metals individually, and starting with gold, because I think a lot of people here at the show are seeing gold near record highs, and they're wondering why aren't the gold stocks performing a little bit better. So wondered if I could get your thoughts on a disconnect.
Yeah, it's a huge disconnect. I think the undervaluation of gold's related equities compared to gold has never been larger. This is typical for the end of a bear market where the physical metal is starting to move and the equities still have to catch up. That's why we predict there will be a very strong rally once the market understands that gold is in a new bull market, but investors will need to see gold moving through 2,100. And this could happen next week, could happen next month, could happen next quarter, but it will happen this year. Why? Because there's such a strong divide between the West and the BRICS countries, the rest of the world. And gold is into play. If you look at the BRICS countries like Russia and China, they're all adding to their physical gold holdings. And the physical gold demand is very strong. And I think because of this geopolitical new reality, this new tension between the West and the East, that will be the reason gold will be moving much higher in the next few years. And gold will more or less return into the monetary system. Like I have described in the big reset, gold has been faded out by the West, out of the financial system, but it's coming back, and the debasement of currency will help in that respect.
Can you expand a little bit more? Because I know a lot of people are very interested in how gold could come back into play in that way. I know it's a really huge topic, but if you can give a brief...
Well, when central bankers who create the money out of thin air are buying physical gold with their fiat money, that's a huge sign. And we've seen record amounts of gold accumulation by dozens of central banks in the last 2 years. And this reminds me of 1969. That was the end of the London gold pool, an effort of central banks, Western central banks, to keep the gold price locked at $35 per ounce to support the dollar. And that failed. So the London gold pool failed in 68. And then we saw in 69 all these countries fleeing towards gold. And actually we're seeing the same now. And that tells me that the stress within the current fiat, the paper money system, is getting very large. And even central bankers are starting to hedge themselves. And because they are the architects of this system, and you should not listen to what central bankers say, but watch what they do. And when they start to buy gold in huge amounts, that's very significant. And even in Europe, we see Hungary growing their gold reserves tenfold. The Czechs do the same. So this is highly significant.
Okay, very important to be watching for gold. And since we don't have too much time, I'm going to keep moving along through the metals. I had the chance to see your presentation here this morning, and silver, I believe you described as an accident waiting to happen. So I love that line.
Yeah.
Can you say a little more about that?
Yeah, if you compare with uranium, I think is a great example. We've been seeing production deficits for decades in silver. We filled the gap by selling the old silver coins, which we used into our monetary system in the 1960s and 70s and early 80s. And the same has been ongoing with uranium. There's been a huge primary production deficits for decades. And suddenly the market noticed that the gap can't be filled. And then you have these hedge funds going all in on uranium. And then you see a breakout of the price. And then then all these states and companies who need the uranium for their for the nuclear stations, they start to panic. And the same could happen with silver. Silver is such there's a production deficit for decades now, and you have 60% of silver being used in the industry as a commodity for solar panels or whatever. And you could easily have a panic among buyers, and then everybody wants to be in silver. And silver is such a small market, and central banks don't have silver holdings, which they can throw to the market. So that's why I think silver is an excellent way to happen.
Although you also said on silver, it's so manipulated, right? So how do we know? I know a lot of people have questions about this. How do we know the price won't continue to just be tamped down?
Because of the physical demand. In my presentation, I showed a graph of Turkish imports of silver, which really tripled. And that's a clear sign. I also showed in my presentation how future markets are being used to suppress prices by selling paper silver, paper gold. And I showed the example that in 2017, we had this huge demand for physical palladium, and then the shorts got squeezed. And then the future markets, we saw a huge decline of the open interest in 2019, 2020. And that's a clear example of what can happen to silver. A short squeeze in which the metal is being demanded and can't be delivered for current prices. And that could shoot silver up to $100 per ounce in a relative short period.
All right. And I also want to touch on uranium because I know you brought it up a number of times, but the price had a really good run in 2023. Where do you think we are in the cycle? You know, is there still room for
Oh, yeah.
Lots. Okay.
Lots. Because if you look at the last cycles, the last one is 2007, we saw a top for uranium at $140, but in current, after the debasement of currency and inflation in current terms, you need a top over $200 per pound to have a similar high. Well, we're just over $100, so I think there's room to double. But if you look at the shortages in uranium and the fact that there's a primary production deficit for quite a long time, there's so many nuclear reactors being built, around 200, 300, 400 are being planned for the next 2 decades, that the demand for physical uranium will stay very strong for the next few decades. And it's a question if production can keep up.
And another question on uranium. So you're, of course, looking on the discovery angle. One point I often hear is the uranium market is so small.
Yeah.
A lot of people give the advice, just stick with the big ones, you know, that's how you can do it. So maybe you can tell me
That's
why.
a great advice.
Okay.
Because in the last cycle, we saw, I think, 150 exploration companies all promoting their new discovery or exploration play. If you stuck to the best discoveries, NextGen Energy, valued at $4 billion now, but that's 20% of the physical uranium market once in operation. So if you stick with the winners, I think that's the safest way to play it. They will do well. And there's also a great ETF, the URA, where you have the basket. So I'm afraid we'll see a lot of promoters coming out and telling you they switched from lithium or from gold into uranium. We stick with the best always, and that has really helped us to survive in the downturn.
Okay, and just as we're finishing up, so I know that you're commodity agnostic. You go where the good projects are. But, you know, if we are looking forward to 2024, we've talked about some of the commodities that may have potential. What else is on your radar?
Battery metals. So 40% of our investments in the battery metal space, and that's mainly copper and lithium. Of course, lithium had a huge correction after it ran 4x or 5x. So that's only natural from a technical analysis perspective. After this correction, 80% is a normal correction after such a run. And it always stops after 80%. So I think this is the time to add to your lithium positions, because we studied the lithium supply and demand. We need over 40 new lithium mines within the next 15 years to have enough lithium for this EV revolution. So lithium will do very well after this correction is over. And then we have uranium, that's like 7% of our fund, and the rest is precious metals related.
Okay, very good. Any final thoughts that you would leave investors with heading into 2024?
Well, the mood is so depressed among investors because we started the fund in 2008. It was the top of the last cycle, the high. So we all the people here at the conference, we're all children of a bear market. And actually, I was present yesterday at the Metal Investor Forum, and a guy gave a presentation. He said, I experienced 2 major bull markets in commodities in 2016 and 2020. And then I started to laugh because the bull market in 2016 was 5 months, and the bull market in 2020 was 5 months. So he never experienced a real bull market. And once you experience a real bull market in commodities, like the ones in the 1970s or the 2000s, you will know it's a bull market and you'll be surprised.
So we won't have to ask ourselves, is it actually happening? We'll know.
Yeah, we'll know. And then I always tell this to investors, out of the next 10 years in a bull market, 6, 7 or 8 will be wonderful. And then you go up not with 10 or 15%, but 50, 60, 70% because it's a huge undervaluation and the huge leverage in these kinds of plays. So I'm looking forward to the next 5 to 10 years well, I really look forward to the next 5 to 10 years.
Okay, very good to hear.
Yeah.
Thank you so much for coming on to talk. Really good to hear from you.
Thank you.
Of course. And once again, I'm Charlotte McLeod with investingnews.com. This is Willem Middelkoop. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.